You said the 3.3 billion was fully available to customers after US regulators had stepped in. What would happen if there was no intervention?
Yeah, I mean, I think, first, we obviously made a commitment that using our own corporate balance sheet as well as external capital if needed, that we would fully backstop that. Obviously, there was a lot of discussion about, what's that recovery look like? Is it immediately available? Over what period of time? And so we were very confident in our ability to do that, which is great. Fortunately, we didn't need to do that. We took a lot of precautions late last week, really starting Thursday, as we started to see a lot of things unfold. We've moved all of our reserve assets to Bank of New York Mellon, which is an extraordinary custodian, as well as held in the Circle Reserve Fund, which is short-term T-bills managed by BlackRock. And so we're really trying to make sure that we've got the most solid infrastructure possible for this digital dollar. And as I expect we'll talk about, it's somewhat ironic that there's been a lot of talk about protecting the banking system from crypto. Here we have a situation where we're trying to protect a digital dollar from the banking system and the limitations of fractional reserve banking, the embedded risk that creates. And we've been advocating for a full reserve model for digital currency for some time at both an operational and a regulatory level.
Yeah, we'll certainly get onto how those regulations are playing out. Just a bit more color on that. You said you were taking precautions. What did that involve behind the scenes? Were you on the phone to potential external sources of funding? What kind of entities were those, or companies potentially involved in that?
Yeah, I mean, we have a lot of great partners as a company, great strategic partners, strategic financial equity partners and others. And, you have some conversations. Fortunately, again, the path that the federal government took was, I think, the right path, as we've seen the risks to contagion, the risks of a broader fallout in the financial system appear to have been systemic. And I think that President Biden, Janet Yellen, Secretary Yellen, et cetera, have made a good set of decisions there. I don't think those risks have dissipated at this point entirely. But the major precautions from our perspective are, let's just make sure that we have as little exposure as possible to embedded risk in the fractional reserve banking system, focus on custodians that really are not significant risk-taking cash custodians. And then obviously we've made this move with daily transparency into the short-term T-bills in the Circle Reserve Fund as well.
Jeremy, just to that point, 101 banking, how you collateralized USDC, what you had bulk of this in US Treasury bills, so short duration, and the rest in cash, the part that was at issue with SVB. How angry are you at SVB that they couldn't get their maturity profile right?
Yeah, I think, I don't want to say I was angry. I think one looks at kind of, well-rated banks, and looks at their fundamental profile, and I think no one expected that you'd see this kind of duration mismatch. But I think this also comes back to is the tightening working? Is one way to ask. The tightening of rising interest rates, basically have policymakers themselves made an error in terms of what that's going to do in terms of the long bond durations that some of these financial institutions hold, and then obviously the deposit base of, as we know, $680 billion of uninsured deposits, that deposit base saying, hey, why am I sitting here when I could go into T-bills? And so I think there's a lot to be looked at from a few angles on sort of whose watch some of these issues have been.